complex pedantic theorem.
Itemized deductions, itemized deductions, exemptions, filing jointly, capital gains, capital gains, exemptions, filing jointly, Schedule A, Schedule C, Schedule D, Schedule SE, Schedule SE, April 15th, April 15th.
Have you ever just wished that you could make your taxes disappear? Does 2 to 5 in a minimum security prison sound more appealing than Form 1040? Fear not, fellow taxpayer, you've come to the right place.
This is No Brainers on Taxes, brought to you by Cerebellum Corporation.
During this tape, we'll get specific. We'll help you decide on all the forms you need and show you how to prepare before you sit down and start.
Hi, I'm Laura Hopewell. Through the course of No Brainers on Taxes, we'll cover the basics of tax preparation as we walk you through the 1040 step by step. We've consulted tax experts, including Robert Cook, certified public accountant and author of Taxes for Busy People, who heads our No Brainer think tank. And now we bring you the results of our labor in the form of a videotape and a small booklet, which is chock full of great info. Quick and easy, that's a no-brainer. Let's get started.
Part 1, Introduction to Taxes.
Despite the reams of forms, fundamentally, taxes are the same for everyone. No matter who you are, you must declare your income and your deductions. You then add these two together and check a tax table to see exactly how much in taxes you owe. Compare this with the amount you've already paid in taxes, and you're left with a number, which is either how much you owe or how much you get back.
We'll discuss things like how much you made in stocks, or paid for a new home, or earned from a home-based business. And even though everything we go over in this video may not apply to your current situation, understanding how the forms and schedules work together is the key to figuring out your taxes. Because on your own, things can get pretty confusing.
The 1040 tax form is just an amalgamation of forms.
Take results from
Schedule A, B, C, D, and SE.
plus Forms 2106 and 2555.
Complete Form 1040, line 57, then file Form 4868.
Actually, it's not this tough. We'll guide you form by form using the personal tax records of a make-believe family, the Hendersons. As we work through their taxes, we'll tell you things to keep in mind while you do your taxes. Let's meet the Hendersons now. Archie, Vicky, and baby Jake.
In exchange for sharing their financial information with us, not only are the Hendersons spared the hassle of preparing their taxes, but they also receive a free vacation. That's right, Archie, Vicky, and little Jake, we're sending you to beautiful Ogden, Utah. You'll spend 8 deliriously happy days and nights at the beautiful IRS complex, where you'll attend Camp Taxes, a short course on the United States tax code. Now, let's take a look at the madcap and fun-filled year the Hendersons had.
The Hendersons.
Late in 1997, Archie landed a job as a salesman for the Atlanta-based producers of low-cost computer chips, Jip Chip Company. Jip Chips really wanted Archie to work for them, so the company paid for part of the family's moving costs. Back in January '98, the Hendersons sold their house in Richmond, Virginia, and moved to their new house in Atlanta, Georgia.
When we moved to Atlanta, I started my own graphic arts business. I do lots of things, but my forte, greeting cards.
Because Vicky is self-employed, she has to file her taxes in a different way than Archie. Archie's employer deducts taxes directly from his payroll, while Vicky, according to governmental decree, makes tax payments quarterly. This year, Vicky put the maximum $2,000 in an IRA account. Archie, for his part, is covered by his employer's pension plan. Vicky owns stock in the Eaton Paint Removal Company, which paid her $200 during the year. At the end of the year, the president of this company, Jim Eaton, sent her a Form 1099 DIV. This form states that she has been paid those dividends. Archie and Vicky also own shares in a mutual fund, the Running of the Bulls Fund. Little Jake is cared for during the day by Mary Smith, a local daycare provider. The Hendersons had owned stock in Amalgamated Combined Company, but after hearing news in August that the company was about to break up, they sold their stock for $10,000. And finally, they won $1,800 in the lottery this past year.
Now that we've met the Hendersons, let's dive right in and look at the forms we'll be using and all the tax info we'll need to do the job.
Part 2, Choosing and Finding the Necessary Forms.
Getting the forms and schedules you need is a great reason to visit your local IRS office.
Local libraries are a bonanza of IRS forms and schedules. If you can't find the form you're looking for, check with the reference desk. Many libraries have IRS forms you can photocopy.
Some other ways to get what you need are to check the internet. You can download forms at the IRS website. You can reach the IRS by calling 1-800-TAX-FORM. Or you can have forms faxed to you by calling 703-368-9694 from the handset on your fax machine. The telephone and fax services are really busy during tax time in April, so be persistent or take a trip to your local library.
Here's a huge problem for any taxpayer. How do you get started, especially if you don't know the forms you need? One way is to dedicate an evening to taxes. Sit down with Form 1040, a cup of coffee, and plug away. However, you'll often realize you're missing a form or two. Then, once you get the form, you'll find out you need another form. So unless you really like all this hassle, we suggest a different plan of attack.
To choose the forms you'll need before you dedicate an evening to your taxes, check your handy-dandy booklet. It has a list of the tax forms that you might need. Let's see what forms and accompanying instructions the Hendersons need.
They need the master form, Form 1040, and Form 6251, Alternative Minimum Tax.
The Hendersons also paid medical expenses and state taxes, made charitable contributions, and paid for business expenses. So we've picked up Schedule A.
The Hendersons also received interest and dividend income from their investments, and Vicky's in business for herself.
Now we have Schedule B, interest and ordinary dividends, Schedule C, profit or loss from business, Schedule SE, self-employment tax, Form 4562, depreciation and amortization, and Form 8829, expenses for business use of your home. They sold some stocks and they sold their house, so they'll need Schedule D, capital gains and losses. The Hendersons paid for their care of their small child, Jake, and paid moving expenses, so Forms 2441, child independent care expense, and 3903, moving expenses, should do it.
Instructions accompany most forms. Be sure to get them. Although they can get slightly confusing at times, you'll find them to be an invaluable resource as you work through your taxes.
Now the Hendersons have all the forms they'll need. We and the Hendersons will be completing the forms and schedules first. Remember, our objective is the master form, the 1040, and we'll use figures from the other forms and schedules to complete the 1040.
Instead of going through the 1040 line by line, stopping each time to find a particular figure from some other form, we'll try something else. We'll fill out just the first part of the 1040, the part that includes the Hendersons' names and their filing status, but then we'll complete all the other forms and schedules. Once we have those taken care of, we can tear right through the 1040.
For the purpose of our no-brainer, we'll divide the Henderson schedules and forms into 4 categories. 1, asset-related expenses. 2, Vicky's business expenses. 3, itemized deductions. And 4, the final run, which includes Form 1040.
Now, let's look at number 1, asset-related expenses. What exactly are assets? Well, an asset is something of monetary value owned by somebody or something. Or, another way of looking at it, an asset is any of your stuff that's worth something. For the Hendersons, assets are their home, bank accounts, CDs, which are certificates of deposit, money loaned out, stocks, and mutual funds.
In addition to these schedules and forms, the Hendersons received a bunch of documents near the end of the year that they'll need come tax time.
Now don't get stressed if you have to put your taxes aside while you track down some receipts or figures you'll need. These records include any W-2 and any 1099 forms you receive. Along with Howard Hughes' will, there are a bunch of things the Hendersons will need.
The Hendersons need the W-2 form Archie received from Jip Chips. The W-2 form is, of course, a year-end statement from an employer. Archie's W-2 includes his salary, all the taxes that were deducted, and some other things that we'll get to later.
We'll also need any 1099 forms the Hendersons received. These include 1099 INT forms and 1099 DIV forms. 1099 INT forms report the Hendersons' interest from banks and brokers. 1099 DIV forms are reports of the Hendersons' dividends from corporations and mutual funds.
We also need closing statements from the purchase of their old residence in Richmond and the recent sale of that residence. The Hendersons may also have received Form 1099-S, proceeds from real estate transactions. We'll get to that one later.
They'll need the name, address, and social security number of their daycare provider. That's because daycare is no longer the underground industry it once was, and the IRS wants to make sure it stays above ground. So the IRS will compare the info from the Hendersons' return with the income reported on the daycare provider's return.
They'll need Vicky's business records, records of their moving expenses, and records of any significant medical expenses incurred, plus Form 1098, which the mortgage company sent them at the end of the year.
Okay, I've got all my records.
Hey Archie, did you get yourself a beverage?
No, I forgot. I'd love a Clamato.
Maybe we should get started on your taxes.
Part 3, Form 1040.
We all know that Form 1040 is the backbone for the tax structure, but it has a number of incarnations. Among them are the 1040, 1040A, and 1040EZ. How do you decide which is right for you?
Form 1040EZ is, as you'd expect, easy. It's for people with the simplest tax situation. It's only used by single individuals with no dependents, which means the Hendersons can't use it because they're married and have a dependent. What's a dependent, you ask?
Well, a dependent is a person who's supported by your income, like a child. You can claim this person as an exemption, which we'll discuss more in just a minute. In short, the more exemptions you have, the more tax savings you can rake in.
Form 1040A is simpler than the regular 1040. Single and married people can use it. Many things, such as IRA withdrawals, total pensions or annuities, unemployment compensation, taxable Social Security benefits, and a few other things can be listed. The big problem with Form 1040A is that you can't itemize deductions. So, what's a deduction?
A deduction is an expense you can subtract from your taxable income, like mortgage interest and some business or moving expenses. Deductions are good things. They lower a person's taxable income and therefore save you money at tax time.
There's an important distinction to make between kinds of deductions. There are standard deductions and itemized deductions. Standard deductions are more straightforward. Let's take a look at the 1040 form.
Say you're single. You can claim a standard deduction of $4,250. Or let's say you're married, and you and your spouse file jointly. You can take a standard deduction of $7,100. So a standard deduction is just that, standard. Anyone can take this deduction without getting into the potential complications of itemized deductions.
Itemized deductions get more complicated. We'll figure out itemized deductions on Schedule A, which we'll get to later on.
Because the Hendersons pay substantial mortgage interest and have many other itemized deductions, they can save mucho dinero by using Form 1040, which is a bonus. They can't use the 1040A anyway because they also have income from Vicky's home business.
So the Hendersons are left with Form 1040. The Form 1040 is the big mother. It can be so complicated, it's often called the long form, or even the long and winding road form. Another great way to think of the 1040 is like a tree trunk.
Say we have this long tree trunk here we want to climb. As we climb to the top of the tree, we need the help of the branches. The other forms and schedules are the limbs that give us the figures we need to get our way to the top and finish climbing the tree.
Let's take a look at Form 1040. Up here at the top, you just identify yourself. We write the taxpayers' names and address and their Social Security numbers. Right below the address line are lines on which they can have $3 of their income tax diverted to the presidential election campaign.
Well, honey, do we or don't we?
The Hendersons, being people of strong political conviction, decided to divert $3 each to the presidential election campaign.
Next, we have filing status. This is your statement of the way you've chosen to file your 1040. The Hendersons are filing as married filing joint return. For a majority of married people, filing jointly saves them the most on their taxes. Next are exemptions. An exemption is a deduction that can reduce your taxes. The actual size of this reduction depends on your tax bracket.
The Hendersons check off exemptions for themselves and enter the name of their one dependent, Jake, here in Section C. They do this by writing his name, Social Security number, and his relationship, and they put a check here for child tax credit. Then we just add up the total number of exemptions, 3, and put it in the box here in Section D.
Many of the numbers you'll be putting down on Form 1040 come from forms and schedules that wind up attached to the 1040. Again, think of the 1040 as your master form.
For instance, as you can see, on certain lines, the 1040 needs figures from Schedule B, Schedule C, Form 4797, Form 2119, Schedule E, Schedule SE, and many more.
But don't worry, by doing the schedules and particular forms first, we'll cut down on a lot of the jumping back and forth between forms and schedules. And don't think you've messed up if you can't fill out a schedule completely. Many forms and schedules are interactive.
Interactive means we'll begin working on one schedule and then we'll need information from another, so we'll switch to it, and once we've found the info we need, we'll return to our original form. Once we get into it, you'll see it's not too tough.
Now that we have all the forms and the records that we need, let's get down and dirty and dig deep into the fertile soil that is the first part of the Hendersons' taxes.
Part 4. Gain and loss from investments and assets.
There are 3 forms we'll use to report the Hendersons' gains and losses from their investments and assets. We'll begin with Schedule B, which deals with interest income and dividend income. Along the way, we'll also cover Schedule D, capital gains and losses. Let's begin with the Hendersons' big move this past year.
Section A. Home and moving finances.
In past years, the IRS had you fill out Form 2119, Sale of Your Home. Well, this form has been chucked into oblivion, and any taxable gain from selling your home goes directly on Schedule D.
Here's a skinny. If you're married, the government allows you to make up to $500,000 on the sale of your house, as long as it's been your primary residence for at least 2 of the previous 5 years, without having to pay capital gains. Pretty cool.
Now, if you think you're eligible for this exclusion, cover your hiney and check the IRS's instructions for Schedule D to make sure.
As we all know, moving isn't just about selling your house and paying taxes, it's also about moving expenses.
Form 3903, moving expenses.
Not only can moving be fun, but you can deduct quite a few other expenses from your move. We'll report the results on line 26 of Form 1040. The form we use to itemize the Hendersons' moving expenses is a little number called 3903. Fortunately, unlike years past, this is now a simple form to fill out. Whew!
Just like almost everything tax-related, you're going to need copies of your receipts on hand to find important figures.
For line 1, we enter $3,000, the amount the Hendersons paid for transporting their household goods and personal effects. For line 2, we enter the travel and lodging expenses the Hendersons incurred while transporting themselves and their possessions from their old home to their new one.
If you drive your own car, figure the cost to be the IRS standard rate of 10 cents per mile, plus any tolls you come across.
To find line 3, we add line 1 to line 2 for the total moving expenses, which is $3,300. Line 4 is the amount Archie's employer paid him for moving expenses, $2,500. How do we find this number in our records? In box 13 of Archie's W-2, there's a P notation. Why is it a P? Somebody deep inside the bowels of the IRS may know, but we sure don't know. For our purposes, it just means that Archie was reimbursed the $2,500 for deductible moving expenses, and that amount is not included in the wages reported in box 1 of his W-2.
Note that if Jib Chips had paid the moving company directly, that would not be reported on Archie's W-2. And Archie wouldn't need to deduct his expenses on this form because he wouldn't have any.
To find the Hendersons' moving expense deduction on line 5, Archie subtracts line 4 from line 3 for a deduction of $800. The instructions now tell us that this figure goes straight to Form 1040 on line 26.
So that's it for one of the simpler forms we'll come across, good old Form 3903. Next we'll tackle the Hendersons' investments, but be warned, it's not going to be another Form 3903.
Section B, Investments.
In this section, we'll take a look at the Hendersons' investments that are listed in Schedules B and D.
Schedule B, Interest in Ordinary Dividends.
Why begin with Schedule B? It's the first form the Hendersons need in order to complete the 1040. Check out line 8. It mentions Schedule B. We use Schedule B to itemize and to total interest and dividend income. We'll begin with Part 1, which covers interest income.
The Hendersons' interest income is the money they made from the second mortgage they took back when they sold their house, and their other investment, which is a CD that yields taxable interest. So, interest income is any income received in the form of interest payments. In addition to mortgages and CDs, some government bonds and any corporate bonds also yield interest income.
So here we are with Schedule B. Let's get started with Part 1, Interest. The first entry is the interest from the sale of their old house in Richmond. They put the buyer's name and his social security number on the first line. Next, we enter the owner's old address and $800, the amount he paid the Hendersons in interest this past year.
The Hendersons need to declare this information because the IRS will look at the Hendersons' Schedule B to see if they reported this interest as income.
How in the world would the IRS know to do that?
Well, Joe Navarro will deduct his mortgage interest payments on his taxes. The IRS insists that he includes the Hendersons' name, social security number, and address on his return. So if this happens and the Hendersons haven't declared the interest income, their names may appear on an IRS list that they don't want to be on.
Now the CD. At the beginning of the year, the Hendersons lent some of their money to the Itsy Bitsy Bank when they purchased a certificate of deposit, or CD.
At the end of the year, Itsy Bitsy Bank sent the Hendersons a 1099 INT form. This form states the interest the Hendersons earned from their CD, $700. This $700 entry goes right below the interest paid by Joe Navarro. For now, let's jump down to Schedule B, Part 2, Ordinary Dividends, which deals with dividend income.
Dividend income is any money paid in dividends you receive from corporations you own stock in or from mutual funds.
Part 1 of Schedule B, Interest, deals with money paid to the Hendersons as a result of their loaning money to an institution like the Itsy Bitsy Bank or to an actual person like Joe Navarro. Part 2 is Ordinary Dividends. Dividend income is a return on ownership. Stocks are a kind of ownership of a company. If the company turns a profit, some of this profit may go to the owners, the shareholders.
Eaton Paint Removal had a banner year, removing paint from walls throughout our fair land. So they paid dividends on their stock. The Hendersons received a dividend of $200. We'll enter Eaton Paint Removal Company here on line 5 and put $200 in the column at the right.
As we mentioned before, the Hendersons also owned shares in the Running of the Bulls Mutual Fund. In 1998, these shares earned them $500. How do we know this?
Well, it's clearly stated on the 1099 DIV form Running of the Bulls sent to the Hendersons. The 1099 DIV form says that the Hendersons received $500. $400 of which are listed as ordinary dividends. We enter this figure into Part 2 of Schedule B. The other $100 they received are listed as capital gain distributions.
A capital gain is the profit one makes by selling an asset for more than one paid for it. The capital gains tax is figured from this amount. Just for giggles, you should know that a capital loss occurs when one sells an asset for less than one paid for it.
Now, you may be asking yourself again, what's an asset? Well, when discussing capital gains, the assets that come to mind are stocks, bonds, and real estate. However, collections of dolls, guns, china, and so on also fall into this category, as do machinery, automobiles, ships, and the like.
What do we do with the capital gains? We enter them on line 13 of Schedule D, Capital Gains and Losses, a form we'll get to in just a minute.
To enter the Running of the Bulls Mutual Fund on Schedule B, we list it here, beneath Eaton Paint. The $400 in dividend income goes here. Those are the only sources of dividend income, so we head down to line 6. The instructions say to add the $200 and the $400, which gives us $600 in ordinary dividends. We also transfer this over to Form 1040 on line 9.
We're going to set aside Schedule B for a while since we're done with it. Now let's figure out the Hendersons' capital gains tax since we already have a start on it.
Schedule D, Capital Gains and Losses.
In layman's terms, a capital gain or loss is the money you earn on an investment when you sell it, over or under what you originally paid for. So if you bought a stock for $100 and you sold it for $120, then your capital gain is $20.
The effect of the capital gains tax is this. The Hendersons are taxed for the profits they make from selling stocks or selling assets.
We already have $100 in capital gains distributions listed here on line 13. This is the entry we just transferred from Schedule B. By the way, a distribution is sort of like a dividend, but they are paid out of the profits that mutual funds earn by buying and selling stocks and bonds.
Back in 1995, the Hendersons bought 100 shares of Amalgamated Combined Company. They sold these shares this past year for $10,000. Because these shares were held for more than a year, they're considered long-term capital gains. To fill out Schedule D, we'll consult the Hendersons' records. We'll need 3 bits of information: the date the shares were purchased and for how much, the date they were sold, and what the selling price was.
The selling price of $10,000 and the date of the sale, September 10th, are listed on the Form 1099 that the Henderson stockbroker sent them. With our trusty number 2 pencil, we'll take that info and put it onto Schedule D in Part 2, Long-Term Capital Gains and Losses. We also need to know how much they paid for the stock in the first place. This is a tougher find. Archie will have to look back in his 1995 records for the broker's annual summary of transactions to find that he paid $7,000 for the stock originally. Now that he's got it, let's put that info onto Schedule D. The shares of the Amalgamated are the only entry on line 8. Lines 9, 10, 11, and 12 don't apply. In line 13, we have the $100 capital gain from the running of the Bulls Mutual Fund. Lines 14 and 15 don't apply to the Hendersons. Line 16 is just adding up the other figures. Its official name is Net Long-Term Capital Gain or Loss. Adding lines 8 through 14 in column F together gives us $3,100.
Because the Hendersons held the stock for more than a year, it's considered long-term rather than short-term. So the info goes here on line 8 of Part 2. He just enters 100 shares of Consolidated, the dates bought and sold, and how much it was sold for, $10,000, and bought for $7,000. The difference between the two is either the gain or loss from the sale. In this case, there's a gain of $3,000.
Part 3 of Schedule D is straightforward. In line 17, we just add the net short-term and net long-term capital gains and losses from line 7 and line 16. Because line 7 is blank, it's just line 16, which is $3,100. Line 18 applies only if line 17 is a loss, so it doesn't apply in the Hendersons' case.
Part 4 of Schedule D is tax computation using maximum capital gains rates. The great thing about this section is it provides us with a number we'll need on line 40 of Form 1040. The unfortunate thing is we need line 39 of Form 1040 before we can do this. So we'll set Schedule D aside until we get to Form 1040. Now the good thing is there are other things we can do to fill our time.
Part 5, Vicky's Business, Profit, Expenses, and Self-Employment Tax.
Not only is owning your own business a huge time commitment, but it's also a heavy tax process too. The proof? We'll be using 4 tax forms. They are 1. Schedule C, Profit or Loss from Business. 2. Form 4562, Depreciation and Amortization. 3. Form 8829, Expenses for Business Use of Your Home. And 4. Schedule SE, Self-Employment Tax. We'll start with Schedule C.
Schedule C, Profit or Loss from Business.
Although Schedule C itself is straightforward, most of the numbers needed come directly from the totals from the bookkeeping records of Vicky's business. Schedule C is also one of the most interactive forms. As we fill out Schedule C, we'll take breaks along the way to fill out Form 4562 and Form 8829. That's because both forms provide figures we'll need to put into Schedule C. Let's get started with Schedule C.
The first part is just Vicky's name and basic info about her business. Part 1 deals with the income that her business yielded.
All of this information comes straight from her books. She has a gross income of $30,000. Part 2 is expenses. As we head through this section, a lot of things don't apply to Vicky, so instead of mentioning each one, we'll just pass over them.
Line 8 concerns advertising, and again, our figure is right from Vicky's books. Vicky spent $2,500 to promote her new business over the course of the year.
Line 10, car and truck expenses, is a little different. Vicky uses her car to visit clients, and she has kept a mileage log, as the IRS requires. Additionally, she decided to avoid the complications of depreciation and detailed expense records. For now, we'll figure Vicky's car expenses by jumping to Part 4 of Schedule C, Information on Your Vehicle. To fill out this section, Vicky uses the information from her mileage log. She enters her business mileage, 1,661 miles, in line 44, and also other mileage, 8,000 miles. This would be anything non-business related, like ice cream runs to the local Stop and Shop. Boxes 45 through 47 are self-explanatory. She marks yes for all of them. To get the deduction on line 10 of this schedule, we multiply Vicky's business mileage, 1,661 miles, by the IRS's rate of deduction, 32.5 cents. This rate is found in the directions of Schedule C. We write the result, $540 on line 10 of Schedule C. Line 13 is a little tricky. It deals with depreciation.
For our purposes, depreciation is a method of spreading the cost of equipment used in business over the several years the equipment is in use. For tax purposes, the IRS dictates how much can be deducted as depreciation each year for various classes of equipment.
There is one stipulation. The Section 179 deduction allows you to automatically deduct up to $18,500 per year of newly acquired equipment without having to go through the hassle of depreciation computations and spreading the deduction over several years.
Instead of depreciating a piece of equipment over time, a special part of the Internal Revenue Code called Section 179 allows a business to deduct the whole cost of its equipment. If you purchase more than $200,000 of equipment in 1 year, your deduction of $18,500 is reduced. If you have questions, check the instructions to Form 4862.
Vicky wants to deduct the cost of the $2,000 computer she bought in January to use for Greetings to You. What we'll do is deduct the $2,000 cost on line 13, which is the line titled Depreciation and Section 179 Expense Deduction. However, we must also report this Section 179 deduction on Form 4562. Strap yourself in, it's time to form jump again. And don't worry, after we finish Form 4562, we'll jump right back to Schedule C.
Form 4562, Depreciation and Amortization.
Form 4562, Depreciation and Amortization, is the place to list all depreciated equipment, including any depreciated under the Section 179 option.
Form 4562 comes with limits or thresholds already printed in lines 1 and 3. The instructions of line 5 say to subtract line 4 from line 1 and enter the result. In Vicky's case, we just bring down the $18,500 because there's nothing in line 4. In line 6, we write computer, then under cost we write $2,000, and under elected costs we also write $2,000. Elected cost is the portion of the total cost a taxpayer chooses to deduct for a particular year. In Vicky's case, she'll elect to deduct the full cost, $2,000, under Section 179.
Line 8 is $2,000. We get it by adding lines 6 and 7. It is the total elected cost of Section 179 property.
The instructions of line 9 say to enter the smaller of line 5 and line 8. Line 8 is smaller, so we write $2,000 on line 9. Line 11 is $18,500 because it's the total on line 5. For line 12, we enter $2,000 because this is the total of the Section 179 expense deduction, the sum of the lines 9 and 10.
Part 2, depreciation for assets placed in service during your 1998 tax year, and Part 3, other depreciation, don't apply to Vicky, so we'll just cut to the chase. Part 4, the summary. But before we do, we should note that Vicky doesn't need to list the computer under assets placed in service in 1998 because she listed it in the Section 179 area.
To finish off Form 4562 in Part 4, Vicky only has to fill out line 21. Which is the total of lines 12, 15, and 16 in column G, and lines 17 through 20. Because all of these are empty except for line 12, we just enter the $2,000 elected cost of Vicky's computer slides all the way from line 12 to line 21. Now that we have the info we need from Form 4562, $2,000 in depreciation, let's strap ourselves in again and form jump back to Schedule C.
We can now fill in nearly all of Schedule C, but we'll have to switch to Form 8829 to get a figure at line 29. So don't take off your form jumping shoes yet.
Now that we've found $2,000 in Section 179 deductions from Form 4562, and we've entered them on line 13 of Schedule C, we're ready for line 14. It doesn't apply to Vicky. Ditto for lines 15, 16, and 17.
We now skip down to line 18 and enter $100 of office expenses, and on line 22, $1,000 in office supplies.
On line 24, we deal with travel, meals, and entertainment, all business-related stuff. Because Vicky doesn't really do any traveling for her business, except to go from her office to the kitchen, line 24A really doesn't apply. However, Vicky did spend $100 on meals with clients. The instructions on the form tell us we can take 50% of this as a deduction, so we put $50 on line 24D.
We're down to one last expense, other expenses, line 27. The instructions for line 27 let us know that these other expenses come from page 2 of Schedule C, line 48 in Part 5. Have a look.
Part 5 is just an area to list other expenses like telephone bills, postage and express, help from a temp employment agency, business-related books and periodicals, or anything else necessary for business that doesn't specifically fit in a category on lines 8 through 26.
Vicky's expenses are phone bills that add up to $600. So we write telephone $600. This is Vicky's only other expense, so we drop the $600 to line 48, the total other expenses. Now we carry the $600 back to line 27. Now we put everything together for line 28, total expenses. That means we add lines 8 through 27, which gives us $6,790.
In line 29, we solve for the tentative profit. All we're doing here is subtracting total expenses in line 28 from the gross income we solved for back in line 7. $30,000 minus $6,790 is $23,210. This goes in line 29.
Now, to find the figure on line 30, expenses for business use of your home, we have to switch from Schedule C to Form 8829. This is a classic case of interactive forms, not being able to complete Form 1 until you complete Form 2 and vice versa. So, let's make the jump to Form 8829, expenses for business use of your home.
Form 8829, expenses for business use of your home.
This home office deduction can be taken if the office is used exclusively and on a regular basis as the principal place of business. Because Vicky runs her business from her house, spends most of her business time there, and the space is used exclusively for business, she meets these requirements for deducting this expense. Let's take a look at how she does this. We'll start with Part 1 of Form 8829, which establishes how much of the Hendersons' home Vicky uses for her business.
Line 1 is the area in square feet that the business takes up in the Hendersons' house. Vicky measures it to be 400 square feet. So we put 400 in line 1. The total area of the Hendersons' house is 2,000 square feet. This goes in box 2. We divide the total of line 1 by line 2 and make it a percentage. We come up with 20%. It goes in line 3. That means that 20% of the Hendersons' house is dedicated to Vicky's biz. Lines 4 through 6 of Form 8829 apply only to daycare centers run from a home, so they don't apply to Vicky. So, to get the percentage on line 7, we just drop down the number from line 3, 20%.
In Part 1 of Form 8829, we found out that Vicky's office takes up 20% of the house. Part 2 deals with figuring your allowable deduction. It's just what Vicky can deduct for her office. We begin with line 8, the tentative profit. $23,210, which we got from Schedule C, line 29. Interactive forms.
Beginning with line 9, notice that there are two columns, one for direct expenses, the other for indirect expenses.
What are direct expenses? They're expenses that pertain only to the business portion of the house. Say, for instance, the door frame in Vicky's business area becomes damaged. Well, the repair would be a direct expense.
Indirect expenses are the expenses that relate to the entire house, like mortgage costs, taxes, insurance, utilities, and so on.
The thing to remember is that direct expenses relate directly to costs dealing specifically with Vicky's office, while indirect expenses deal with the costs of the entire house.
Well, line 9, casualty losses, doesn't apply to the Hendersons' house. Line 10 deals with deductible mortgage interest. The Hendersons paid $10,000. This is an indirect expense because the Hendersons paid this money in relation to the entire house, not just Vicky's office. You'll see that nearly all of the expenses coming up are indirect expenses. Now, how do the Hendersons get these figures? Well, one of two ways.
If they pay their insurance within their mortgage payment, the figure should be in the statement they receive from the mortgage company at the end of the year. If they pay for the insurance directly, they need to consult their checkbook and invoices from the insurance company for the figure.
Line 11, real estate taxes, is an indirect expense of $3,000. To find line 12, we add lines 9 through 11 for $13,000.
Keep in mind, the business area of the house is 20% of its entire area. To find the proportionate amount of indirect expenses, we multiply the amount on line 12 by the 20% in line 7 and enter the result, $2,600 in line 13.
For line 14, we add the direct and indirect expenses from lines 9 through 12. However, there are no direct expenses, so we just shift the indirect expenses, $2,600, over to line 14. For line 15, we subtract line 14 from line 8. The $23,210 of tentative profits we carried over from Schedule C for a running total of $20,610.
Why did we do this? Well, the IRS taxes only your amount of profit. Vicky can deduct these expenses, the cost of running her business, from her profit. That way she pays taxes only on the money she earns.
Line 17 covers insurance, for which Vicky paid $800. This insurance was coverage of the whole house, so it's an indirect expense.
According to the IRS, insurance on a business building is deductible. But insurance on a residence is not. So the Hendersons can only deduct a portion of the insurance that covers Vicky's home office, 20%. So in essence, they're deducting $160 of the $800 total that they paid in insurance.
Line 18 is our first direct expense, repairs and maintenance. Back in July, an errant baseball cracked a window in Vicky's office area. The repair cost $100. Because this window directly relates to Vicky's business area, it's a direct expense.
Another repair was made in September when the Hendersons had to pay $500 to repair a cracked sewer line from their house to the street. That's $500 in indirect expenses. Just like everything else, the Hendersons will need receipts for these items.
Line 19 is utilities, things like electricity and gas. The Hendersons spent $2,000 this past year. For line 21, we add up the totals in columns A and B. We have $100 in column A and $3,300 in column B. In line 22, we use the percentage we computed in line 7, 20%, and multiply it by line 21, column B, because Vicky can only deduct 20% of indirect expenses for $660.
So now we figured out the direct and indirect expenses of Vicky's home office. $100 of direct expenses and $660 of indirect expenses.
For line 24, we add all of Vicky's home business expenses. These are the figures in line 21, column A, plus line 22, column B, for $760 in total expenses. The instructions for line 25, allowable operating expenses, tell us to enter the value of the smaller of line 24 or line 15. Since the value in line 24, 760, is smaller, we re-enter that value here on line 25. Line 26, limit on excess casualty losses and depreciation, is just line 15, 20,610, minus line 25, 760, for a value of 19,850.
Because we need to solve for depreciation of the house in line 28, we can't complete part 2 of Form 8829 without solving for depreciation. So let's bounce down to part 3, depreciation of your home.
We'll be using some figures from the Hendersons files here, like figures that detail the value of their house and the value of the land the house is built on.
The home's value, $150,000, goes on line 35. Line 36 is the value of their land, $30,000. Line 37 is the basis of the building. The basis is just the value of the home, $150,000, minus the value of the land, $30,000. The basis of the Hendersons' house is $120,000.
So how do they know the value of their home and land? Well, they received a statement from the city of Atlanta. In fact, most cities and counties assess the value of all real estate every couple of years and then send this info to the homeowner. Usually there's a breakdown of how much the house is worth and how much the land is worth.
To find the business basis of the building, we multiply $120,000 by 20%, the amount of the house dedicated to Vicky's business. 20% of $120,000 is $24,000.
We put the $24,000 on line 38. Line 39 asks us for something called a depreciation percentage. We actually find this percentage in the instructions for Form 8829. It's in a special table. In this case, we find it to be 2.461%. On line 40, we find the depreciation allowable. This is $24,000 times the depreciation percentage, 2.461%. It equals $591.
So we have $591 of allowable depreciation here in line 40. Now, wonder of all wonders, this is the info we came down to part 3 to get. So now we can go back to line 28 in part 2.
Here we are. The line 30 instructions say to add lines 27 through 29. We just enter $591 on line 30. Line 31 is the smaller of line 26 or line 30, so that's $591. Line 32 is the sum of the totals on line 14, $2,600, line 25, $760, and line 31, $591. So we have a grand total of $3,951. Line 33, casualty loss, does not apply. And line 34 is the allowable expenses for business use of Vicky's home. It's line 32 minus line 33, which is $3,951.
Now we're almost done with Form 8829. All that's left is to take allowable expenses for business use of Vicky's home, line 34, and transport it right where we left off on Schedule C, line 30. And we're done with Form 8829.
Here's Schedule C with the $3,951 on line 30. To get the net profit for line 31, we subtract line 30, allowable expenses for use of Vicky's home, from line 29, tentative profit. This gives us a net profit of $19,259, and that's what Vicky made with her biz. Schedule C's instructions tell us to plug this value into Form 1040, line 12, and line 2 of Schedule SE, self-employment taxes.
Why are we sending this number to Form 1040 and Schedule SE? Well, this is Vicky's business's net profit. It's what she earned in the past year. We're sending it to 1040 because she needs to declare her income to the IRS, and we're sending it to Schedule SE because that's the form we use to figure out self-employment taxes.
Hardly anyone who works for a living escapes Social Security taxes. Employees such as Archie pay them through payroll deduction. Self-employed people have to figure out and pay Social Security taxes themselves. They must compute the Social Security tax on the net profit from their business and pay it along with the payment of their income tax.
Schedule SE is a relatively simple schedule. Line 1 doesn't apply because the Hendersons don't own a farm. We take Vicky's net profit from Schedule C, $19,259, which we just completed, and put it on line 2. Line 3 is the addition of lines 1 and 2. Now, to get line 4, net earnings for self-employment, we multiply line 3 by 92.35%. Where do we get that percentage? Well, it's found right here in the Step 4 instructions. This equals $17,786. The instructions for line 5 state that if line 4 is less than $68,400, we multiply line 4 by 15.3%. When we do this, we get $2,721. These are the Social Security payments Vicky owes. Remember, this is in addition to the other taxes she must pay. We transfer this value to Form 1040, line 50. It's in the Other Taxes section on the second page of Form 1040.
Hold on. You're not getting out of Schedule SE so quickly. There's one more step down here at the bottom. This is the deduction for 1/2 of self-employment tax. We find it by multiplying line 5 by 50%. It's $1,361. We transfer this to Form 1040, line 27, because the form says so. And if you don't obey the tax forms, well, bad things can happen. And that's it for Vicky's business expenses.
Well, believe it or not, we're done with all the preliminary work. We're ready for the final run, which means a jog through the 1040.
Part 6, the final run.
During this last part of the Hendersons' taxes, there's only 6 forms that we'll need. 6 forms. Actually, it doesn't sound so bad. We're tax pros, we can handle it. Here they are.
Schedule A, Itemized Deductions, Form 1040, the U.S. Income Tax Return, and Form 2441, Child Independent Care Expenses. Plus, we're going to finish up Schedule D, capital gains and losses, that we started earlier. And we'll have a couple of surprises along the way. Let's get started with Schedule A.
Schedule A, Itemized deductions.
Schedule A is where all those pesky itemized deductions like health costs, miscellaneous taxes, interest paid on mortgages, and gifts to charity are all listed together. Now, because Schedule A relies on Form 1040 and vice versa, we'll do part of one form, then we'll switch to the other one. But don't worry, by now this form jumping business should be old hat.
The first section of Schedule A covers medical and dental expenses. Because Archie and his family are covered by his employer's medical plan, the Hendersons' medical expense was only some dental work.
The Hendersons incurred other medical costs like deductible, co-payments, and dental expenses for a grand total of $2,500. That $2,500 goes right here on line 1.
But watch out, there are lots of things you'd think you could deduct for medical and dental expenses that you actually can't. You should check Publication 17 to see which ones are copacetic and which ones aren't.
Because lines 2 and 3 rely on info from Form 1040, we'll leave them until later. For now, let's jump to the next section, the taxes the Hendersons have already paid.
First, there's state income tax, which goes right here on line 5. This is the amount, $1,600, that the Hendersons paid in state taxes during the year through withholdings from Archie's paychecks and Vicky's quarterly tax payments.
Line 6 asks for real estate taxes. The Hendersons paid real estate taxes totaling $3,000. However, remember that 20% of the Hendersons' $3,000 in real estate taxes, or $600, was deducted on Form 8829 as expenses for business use of your home when we were doing Vicky's business expenses. So they can only deduct the difference of line 2, or $2,400, here on line 6. Next, for line 7, the Hendersons' personal property taxes totaled $500.
Personal property taxes have to come from the Hendersons' records or files. The best way to keep track of the amount is to write checks for your personal property taxes. But if you're ever selected for an audit, the IRS is going to want to see the actual tax bills. Other local taxes are usually some form of property tax, so they also belong on line 7. Other fees and taxes, such as sales tax, aren't deductible.
Line 8, Other Taxes, doesn't apply because the Hendersons paid no other taxes. Line 9 is just the sum of lines 5 through 8, which is $4,500.
Now let's move down to the interest you paid section. This section covers exactly what you'd think.
The only interest the Hendersons paid last year, other than interest on credit card debt, was $10,000 of home mortgage payments. Their mortgage company bank sent them this information. Some companies send this info on other forms, not the official 1098, but the IRS does accept these substitute forms. However, notice the pattern. $2,000 was already deducted with Vicky's business expenses on line 10B, Form 8829, so only $8,000 can be deducted here.
There are no other entries that apply, so we just write $8,000 here on line 14, and that's the interest you paid section.
Let's take a look at the next part of Schedule A, gifts to charity.
The Hendersons made a donation of $750 to their favorite charity. Any gift of $250 or more, either cash or property, must be documented by a receipt from the charity. A canceled check won't do. For anything less than $250, it's good to have a receipt to back up your claim, but it's not necessary.
However, anyone who makes a contribution of over $500 of non-cash property must also file Form 8283. Another form. Actually, it's a straightforward form. Although we won't do it here, be aware that it exists.
In line 18, we enter the sum of lines 15 and 16, which is $1,150. That's it for the gifts to charity section.
The next section is casualty and theft losses, which doesn't apply to the Hendersons. If the Hendersons had property stolen or destroyed during the year, they'd have to file Form 4684 to declare their losses.
Before we set Schedule A aside, notice that moving expenses aren't entered here as miscellaneous deductions. That's just the way that the IRS wants it done. That is, it's not an itemized deduction taken on Schedule A. Actually, it's deducted on page 1, line 26 of Form 1040. The Form 3903 just supports that deduction as proof or evidence.
With nothing else holding us back, let's get started filling out the big form, the form of all forms, the Form 1040.
Form 1040, U.S. Individual Income Tax Return.
Now Vicky and Archie can put all their tax return information together and determine the good or the bad news.
We head to the income section. As you notice, we've already filled a lot of it in. That's the beauty of all our work so far, but we still have more to do.
Let's begin with line 7, Archie's income. This is found in box 1 of the W-2 form that his employer has sent him, $55,000. Schedule B, line 4, tells us the total of the Hendersons' taxable interest, which is $1,500. That goes on line 8A of the 1040. For line 9, we look at Schedule B again. Line 6 gives us $600 in ordinary dividends, which we then plug into line 9.
Line 10 is a different beast. It comes from state taxes. The state send the Hendersons, and for that matter, everyone in the state, a 1099-G form. On it is a list of taxable credits and refunds. That's where the Hendersons find the $400 value they put on line 10.
Archie and Vicky have a strong marriage, so line 11, alimony received, doesn't apply. On line 12, we put the $19,259 of Vicky's business income from Schedule C. On line 13, we have a figure from Schedule D. This is the capital gain of $3,100 from the Hendersons' investments. Now we're really cooking using all the forms to help us.
Lines 14 through 16 don't apply to the Hendersons, but we'll give you a quick overview. Line 14 deals with other gains or losses, which would be covered in Form 4797, Sales of Business Property. It's a pretty complex form, but suffice it to say that it relates to the gain or loss on business assets that have been depreciated in prior years. Lines 15 and 16 deal with taxable and non-taxable total IRA distributions and total pensions and annuities.
Lines 18 through 21 are simple. They deal with farm income, unemployment compensation, Social Security benefits, and other forms of income like prizes, awards, gambling winnings, and jury duty fees. The only thing that applies is the $1,800 they won in the lottery, so they stick that amount in line 21. Line 22, the total income, is just the total of lines 7 through 21, $81,659.
Okay, we've solved for income. Now we'll solve for adjusted gross income. Why? This is the same as income, only deductions are considered, like IRA payments, moving expenses, and self-employment taxes. So the adjustments in adjusted gross income are deductions from total income. Let's take a look.
In box 23, Vicky has deposited $2,000, the maximum, in an IRA. She can do this because her business showed at least a $2,000 profit. New tax laws allow her to do this even though her spouse, Archie, is covered by his employer's pension plan.
If Vicky can afford to stash away more cash into a tax-deferred plan, then she should consider a KEO plan. These plans are only available to self-employed individuals. They operate like IRAs, except that the limit on contributions is much higher than the $2,000 limit on IRAs.
Line 24, student loan interest deduction, and line 25, medical savings account deduction, don't apply. Line 27 is from Schedule SE. It's half the self-employment tax, $1,361. Skipping to line 32, we add lines 23 through 31 for a sum of $4,161. Line 33 is found by subtracting line 32 from line 22. So $77,498 is the Hendersons' adjusted gross income.
Let's take a look at the adjusted gross income. It's just the income minus some valuable deductions, such as the IRA, moving expenses, and half of Vicky's self-employment taxes. Now that we have the adjusted gross income, we can complete Schedule A. We enter the Hendersons' adjusted gross income on line 2 in the medical and dental expenses section of Schedule A. The instructions of line 3 say to multiply line 2 by 7.5%. This gives us $5,812. The instructions of line 4 say to subtract line 3 from line 1. If line 3 is more than line 1, enter 0 for line 4. In this case, line 3 is more than line 1, meaning the Hendersons can't deduct any of their medical expenses.
Why is this? Well, the IRS prevents people from deducting medical expenses that are less than 7.5% of their adjusted gross income. That's just the way it is.
The last thing to do with Schedule A is to add up all the deductions on the far right-hand side of the page.
$4,500 plus $8,000 plus $1,150 add up to $13,650. We transfer this to Form 1040, line 36, Itemized Deductions. We'll have more to do with this amount in a bit, but for now, we're finished with Schedule A. Let's jump back to Form 1040.
We're at the beginning of page 2 of Form 1040. Line 34 is the adjusted gross income carried over from page 1. Line 35 is an age, physical handicap, or naturalization status question that doesn't apply to the Hendersons. Line 36 is what we just solved for in Schedule A, $13,650. Now, the directions for line 36 say, enter the larger of your itemized deductions from Schedule A, line 28, like we did, or standard deduction, shown on the left.
The deduction to the left for married filing jointly is $7,100, which is much less than the $19,916 we solved for in Schedule A. So, in line 36, we'll stick with the Schedule A value.
To get line 37, we subtract line 36 from line 34 for $63,848. In line 38, we follow the directions on the line and multiply $2,700 by the total number of exemptions. It's 3, Archie, Vicky, and Jake, for $8,100. Then we subtract this from line 37 for a taxable income of $55,748.
Wow, we're so close we can taste it. We're just about ready to compute the tax the Hendersons owe. But first, now that we have the Hendersons' taxable income, we're going to jump over to Schedule D, capital gains and losses.
That's because the Hendersons have long-term capital gains. If you don't have long-term capital gains, you can find your income tax figure on the relevant tax table and just enter it on line 40 of Form 1040.
Remember this from earlier? We're transferring the Hendersons' taxable income, $55,748, to line 19 on Schedule D. Finishing up Schedule D, the instructions for line 20 say to enter the smaller of line 16 or line 17, which is line 16's $3,100. Line 21 doesn't apply because we're not filing Form 4952. The instructions of line 22 say to subtract line 21, 0, from line 20, $3,100, so it's still $3,100. Line 27 says to subtract line 26 from line 22. It's $3,100. Line 28 says to subtract line 27, $3,100, from line 19, which is $55,748. This gives us $52,648 on line 28.
Hang on tight. The whole form is this way, just a series of computations, additions, subtractions, and comparing of forms. In fact, what we're going to do is skip down a little on the form to point out a couple of the stickier points, like line 33.
Line 33 tells us, figure the tax on the amount on line 32. Use the tax table or tax rate schedules, whichever applies. We open up our trusty instructions to Form 1040 and consult the tax table. It tells us that, for an amount of $52,648, the tax is $9,230, so we enter this on line 33.
A note about lines 53 and 54. The difference between line 53 and 54, which is $248, is what the Hendersons save by making this computation on Schedule D. That is, it's the additional tax refund they receive because of the maximum tax rate of 20% on most long-term gains.
The rest of the form is just multiplying, subtracting, and comparing lines. So we're going to take away all of the suspense. The tax is, drumroll please, $9,850. We're now done with Schedule D. But we need to transfer this tax to line 40 of Form 1040. Now we're done with Schedule D.
Okay, now we got the credits to factor in.
A credit is just a tax break. It's like a coupon you can use against the taxes you owe.
Line 41 is a credit for child and dependent care expenses. We're going to take this credit. Surprise, surprise, there's a form we're going to have to use to get it. We need Form 2441, Child and Dependent Care Expense. This results in a tax credit rather than a deduction. We won't go through it because it's very straightforward. The important things to note are that the Hendersons have to list the name and social security number of their babysitter, and they receive an $80 tax credit.
As it turns out, the Hendersons can also take a credit on line 43, Child Tax Credit. To find out if you are eligible for this credit, check the worksheet for Form 1040 instructions.
You may have to fill out some portions of it, but it's pretty easy because you just plug in numbers you've already completed. Now Archie pauses at line 51 to see if he and Vicky are subject to the alternative minimum tax. He does this by filling out the worksheet on page 34 of the Form 1040 instructions. After filling out the worksheet, Archie finds out that they aren't subject to this additional tax, thankfully.
Now, moving on to the next section, other taxes. We find that the Hendersons do need to pay a few other taxes. When we figured out Vicky's self-employed tax on Schedule SE, we entered it on line 50 here on Form 1040.
To find the total tax, we add the tax in line 49 plus Vicky's self-employment tax in line 50 for a total tax of $12,091, which goes on line 56.
Well, that's it. No more taxes put on the Hendersons. Next section's all about payments they've already paid. Beginning with line 57, we're paying taxes.
In line 57, we write the federal income tax withheld from Archie's W-2 form, $10,000. The estimated taxes on line 58 were the total paid by Vicky on a quarterly basis to cover the income and Social Security taxes that would be due on this tax return.
Those are all of their payments. Now we add these up for their total payments on line 64, which is $14,000. From these payments, we subtract the total tax, $12,091. We get $1,909, which they overpaid. This is their refund. That's it. The Hendersons get a $1,909 refund. They have no more taxes to pay. Archie and Vicky Henderson, you just got a huge refund. What are you gonna do now?
We're going to Ogden, Utah!
Camp Texas, here we go!
Well, our job is done here, and come tax time, we hope you get the same good news the Hendersons got. If you have any questions or comments about this tape, please give us a call at 1-800-238-9669. And be sure to check out some of our other great no-brainers, like auto care, buying a new car, and wine. Thanks for watching.
Great assistance was provided by Robert A. Cook, CPA and author of Taxes for Busy People, published by McGraw-Hill. Bob's knack for making difficult concepts easy to understand makes this book the next place to look for help on your taxes. He's also written 5 other books covering such subjects as personal finance, accounting, and business taxes. Check him out.
Introducing another exciting video series from Cerebellum, the award-winning Standard Deviants. Recommended by university professors and teachers across the nation, the Standard Deviants are helping students everywhere. The Standard Deviants cover all major subjects and present tough course material in an enjoyable and informative video format. Watch as the Standard Deviants help you understand today's most difficult courses, including algebra, accounting, calculus, chemistry, differential equations, English composition, finance, marketing, organic chemistry, physics, psychology, Spanish, statistics, trigonometry, and much, much more. Get started today with the Standard Deviants. Call 1-800-238-9669 to find the store nearest you or visit us at www.cerebellum.com. The Standard Deviants, 1997 and 1998 15-time Telly Award winner for Best Educational Video.